What is your most valuable asset? Your property, your car, your jewellery? Unlikely. For most, and particularly for the younger demographic, your most valuable asset is you. Or more specifically, your ability to earn an income. Whilst nearly everyone almost always focuses on investment and wealth accumulation, for every plan A there must be a plan B. Let's talk about financial protection. Welcome to another episode of Money Matters. I personally love talking about investing and really enjoy advising my clients to help them on the right path to investment success. However, we must acknowledge the fact that life doesn't always go according to plan, and fate sometimes throws us a curveball. For many families, there is one individual who is the breadwinner. They may be a senior executive or a business owner, and without them, there would be severe implications to the family finances. So much so that whatever wealth has been accumulated, it is not enough to sustain the family indefinitely. Lack of liquidity, defaulting on loans, selling of personal assets, cancelling private memberships and schooling, and even bankruptcy. These are some of the events that may follow the loss of the family breadwinner. However, if it's the loss of the home carer, even though they do not earn an income, this could have a significant impact on the family finances too. You may need to hire a nanny, a cleaner, consider boarding school, the list goes on. Even if both parents are working, the family expenses usually depend on both incomes, and to lose one may necessitate a severe restructuring of the family finances and a dramatic change of lifestyle. It may not even be as severe as death. It could be a liability to a business partnership. It could be the business going into administration. It could be divorce and remarriage with kids from another parent. There could be a number of events that we cannot foresee. Creating a plan B is really a form of risk management. We don't want to use plan B, but it's there if we need it. We must also acknowledge that there is no silver bullet. There are always some compromises. Let's get started with life insurance, the easiest to understand concept. The event we are referring to here is death, specifically premature death. You can imagine that wealth is accumulated through the earning of income, the saving of disposable income, and the investment of excess cash reserves. You can also imagine that an individual in their 20s will not have as much wealth accumulated as compared with an individual in their 50s. They simply haven't earned as much money in that short period of time. You can imagine someone in their later life cycle having less need to protect their earnings, as they've already likely accumulated enough wealth to no longer rely on their income and have reached the state of financial freedom. Any children that they may have may be close to becoming financially independent, i.e. they have finished their formal education and are now earning an income. Therefore, in older age, whilst the probability of suffering a severe illness that leads to premature death is relatively high, for example cancer or heart attack, the financial impact is relatively low, as there is usually significant wealth accumulated already. Contrast this with a young and healthy individual whose likelihood of suffering a premature death may be relatively small, but since they have not yet accumulated any significant wealth, the financial impact of premature death may be devastating. There are a number of solutions for these types of risks that all fall under the category of insurance, the most basic of which is a term assurance policy, which pays out a set amount upon death if occurring within a set term. There is a term because, as we mentioned earlier, the need for financial protection at the latter stages of life is not required. Furthermore, we already mentioned that the probability of ill health occurring in the latter stages is high. Therefore, the cost of insurance is also high to reflect this. There are those that don't like the idea of not getting anything back from an insurance policy, For these individuals, they opt for what is called a universal life plan or a whole of life plan. These policies guarantee to pay out on eventual death as long as you fulfill the premium payments, as there is no term to the policy. I personally question these types of plans for most people as they are significantly more expensive and they effectively become an investment plan. It's worthwhile analysing the illustrations carefully and work out if a separate investment plan paired with a term policy might work out a better strategy. However, they have their uses in specific cases, such as paying for any estate taxes upon death, creating liquidity when most needed. The advantage is that this money is not part of the estate and not subject to the grant of probate process, nor is it subject to estate tax. They may also be used to equalise the distribution of wealth. For example, if a business is the bulk of the family wealth and is passed to only one child, the whole of life plan can pay out to the other children to ensure fair distribution of wealth. So they certainly have their uses. Other than death, there are policies that cover critical illnesses, inability to work or disablement, and policies that pay out for medical fees. There is an insurance policy for nearly every event where a financial loss is involved. There is little point in covering smaller potential financial losses. We don't want to mitigate every single risk, but manage some of the events that would have the biggest financial and personal impacts on our wealth and on our lives. The trick is in finding the right balance between paying some premiums to create a plan B, but ensuring that plan A is still the main focus. This right balance is dependent on the individual. Like I mentioned earlier, having a plan B is a form of risk management, and risk comes in many forms. For those in latter stages, having had a successful career or business and accumulated significant wealth, the focus is less on accumulation but preservation and protection for future generations. There are many reasons how wealth can be lost, but here I'll share a few examples. For those with a successful business, they may have already involved their children in the business and it becomes a family business. They expect that the business will be taken over by the next generation, but how does one pass on the business to the children equally? It may be the case that not all the children are involved in the running of the business, who has control of the business and who simply receive a share of the profits. It may be the case that the owner is concerned with debtors and must protect the business assets from potential claims. It may be the case that the management of the business should be left to third-party professionals instead of the children. In partnerships with joint owners, in the event of premature death of one of the owners, again, insurance is used to protect the surviving owners. Upon premature death of one of the owners, there is usually a shareholders agreement in place that forces the shares to be sold to the surviving owners, as they do not want third parties to have a stake in the business. However, a lack of liquidity may be an issue. Insurance policies set against the lives of each of the owners solves this issue, and the likely outcome is that the spouse of the deceased owner will receive a cash payment in exchange for the shares to be paid back to the remaining business owners. Other than the directors, there may be other key persons such as a sales director, whose contacts are the key to the success of the business, and their premature death may have a significant cash flow impact on the business until a suitable replacement is found and new contacts are established. These types of cover are given fancy names: succession planning and continuity planning. But essentially they are life insurance and potentially critical illness cover for owners and key persons of a business. Other than business cases, it may be that the parents are concerned with the spendthrift nature of their children. Otherwise, marriages don't always last and they want to protect the family wealth from divorce claims. Furthermore, estate taxes may be largely negated, although not an issue in Hong Kong. Wealth built up in one generation can easily be lost in following generations without structures and rules in place. To structure wealth is to leave a lasting legacy for generations to come. Trusts are the tools of choice for many, and there are many different types. Trusts are legal arrangements through which assets provided by one person, the settlor, are managed by another, the trustee, for the benefit of a third party, the beneficiary. In broad terms, a trust is a way of gifting property, which could be any kind of property: land, buildings, shares, securities, cash, and so on. We won't go through every trust in this video. Suffice to say that trusts are commonly used by high net worth individuals. However, as mentioned earlier, there are always compromises, and trusts also have their limitations. The main one is the loss of control, as the settlor is giving up legal ownership, with control of the assets being passed to the trustee. Other disadvantages include the limitations of investment options, as trustees tend to avoid more speculative or aggressive investments. They are also time efficient, as the distribution process is highly administrative and time consuming. The concept of trust is also a little tricky to understand for many customers. This is compounded by the fact that international assets where legislation varies. Last but not least, the high setup fees and annual fees associated with trusts limit the use to the high net worth community only. Other than trusts, and coming back to the issue of divorce once again, pre- and post-nuptial agreements are used to limit losses in divorce claims where one party is significantly more wealthy than the other. Whilst pre- and post-nuptial agreements are a difficult topic to approach for couples, divorce is a common occurrence, and these agreements are practical solutions to wealth protection. Wealth management is a dynamic topic with opinions and priorities that change over time depending on their circumstances and goals. There is never a silver bullet, but successful wealth management comes from continued diligence to follow the client's life journey and to provide support and advice using 2 ears and 1 mouth. That is to say, it is important to listen carefully and understand clients' needs before offering concise advice to help them move forwards. Sometimes it is difficult for clients to articulate what their needs are. Our role as wealth advisors and managers is to help them identify and quantify where they are today and where they want to get to tomorrow. A life journey is a dynamic one. That is what makes this industry so interesting. The world changes fast, and we follow our clients' journey intently and support them and their family throughout their life journey, whatever the future may bring. Life is like a box of chocolates. You never know what you're going to get next. But with a well-structured plan B in place, you can have peace of mind that your castle is well fortified for whatever storms that lie ahead. Thank you for joining me on this episode. Let me know what other topics you would like to hear about in future videos. If you liked this video, hit the like button, subscribe, and I will see you in the next episode of Money Matters.